the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know, I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released.
In recent months, the spotlight has been turning back toward precious metals, and for good reason. Silver, long seen as gold's more volatile cousin, is showing signs of something far bigger beneath the surface. Both structural and monetary pressures are converging, with industrial demand, government policy shifts, and financial market dynamics colliding in ways that could ignite a sustained and explosive rally. For seasoned investors, the signals are clear. This is not business as usual. One of the clearest pressure points lies in the exchanges themselves. London's Bullion Market Association and the COMEX in the United States are facing record levels of deliveries at the same time as available free float supplies continue to tighten. On one hand, speculators are returning to gold, with open interest rising in line with traditional expectations. On the other hand, silver is behaving differently. Lease rates in London are surging to levels not seen in decades, pointing to a scramble for metal that is far more intense than most market participants realize. The liquidity cushions that once underpinned confidence in paper contracts are vanishing, leaving the system strained. Meanwhile, silver is no longer just another industrial input. It has been officially added to the U.S. government's list of strategic minerals. This single designation has profound implications. It signals that Washington itself acknowledges silver's critical role in defense, energy, and technology, and that state-level accumulation will increasingly compete with corporate giants like Tesla and with private investors. When industrial buyers, governments, and retail investors converge on a market that has historically run thin on supply, the result is not just rising prices, it is the potential for systemic dislocation. The technical picture only adds fuel to this narrative. Silver's long-term chart shows a rare and powerful setup, a 45-year cup and handle formation that represents decades of suppressed energy waiting to be unleashed. Technical analysts often point to these formations as indicators of parabolic moves when the breakout finally occurs. Combine that with the fundamental forces of supply shortages, surging lease rates, and intensifying delivery pressure, and the stage is set for a potentially historic repricing of silver. Before we dive into Andy Schectman's full breakdown, keep in mind that he goes beyond just highlighting silver's coiled spring dynamics. He connects the dots between European banks under stress, the Federal Reserve's shifting policy stance, and the quiet but relentless accumulation of physical gold and silver by sovereigns and institutional money. His insights reveal how these developments may converge to reshape the global financial order in ways that most mainstream voices continue to ignore. If you're serious about understanding where silver and gold could be headed in 2025 and beyond, stay tuned. Make sure to subscribe, hit the like button, and let us know in the comments what role precious metals play in your own strategy. Now, let's get into Andy Schectman's analysis.
There's no question that something bigger is happening. I mean, there is no question about that, right? And a lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal. Open interest is rising, and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze, because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver, its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates, an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress. this is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know, I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released, kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base, in silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011. So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100.
The possibility of a silver short squeeze is no longer a fringe idea. The evidence is mounting right in the market data. Lease rates in London have spiked to levels far beyond historic norms, signaling that metal is increasingly scarce and costly to borrow. At the same time, open interest is shrinking while deliveries remain heavy, which means those holding short positions are struggling to find enough silver to cover their obligations. This is the classic setup for a squeeze, where the cost of maintaining short bets becomes unbearable and positions are forced to unwind. This backdrop explains why central banks, sovereign funds, and institutional players are shifting away from paper promises and toward physical bullion. The exodus of metal from London to U.S. vaults has stabilized American banks, but left European institutions facing mounting existential risks. And as Andy explains, it's not just about banks. It's about big money, quietly parking capital into tangible assets like gold and silver, while the mainstream narrative keeps the public focused elsewhere.
And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39%, when compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%. The S&P is 67%. That's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400. I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, It's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom-pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and can keep on going every single month. Every single month, we are seeing huge deliveries into COMEX. And why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market. Not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash. And they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I? I found it interesting, in particular, that this guy, article from investing.com, I'm going to read it to you because Adam Lipinski again, and I don't know if you remember Glupinski, I talked a lot about him a year ago, and I'm going to read what I said about him a year ago after I read this. I want people to think big picture. This is coming from the head of the Polish National Bank, the central bank. This is from investing.com. Poland's central bank announces plans on Wednesday to increase its gold holdings to 30% of its reserve assets, aiming to strengthen the country's financial security. Glupinski says in these difficult times of global turmoil and the search for a new financial order, gold is the only safe investment for state reserves, NBP Governor Adam Glupinski said in an emailed statement. He is proposing a motion to the bank's management board about raising the reserve target for gold to 30% from their 22%. Now, remember, I said I was all over this in 2023, screaming about this. Let me read to you what Adam Glupinski said in 2023. When asked, why does the central bank hold gold? Because it retains its value even if someone cuts off the power to the supply of the global financial system, which is based upon electronic accounting records. Of course, we do not assume that this will happen, but as the saying goes, fortune favors the prepared, and a central bank must be prepared for the most adverse circumstances. This is why gold has a special place in our currency management process. So he's basically saying, think about everything digital. When someone cuts the power to the financial system that is all based on electric accounting records, this is why we own gold. And now he's increasing it to 30%. When you look at the most well-informed traders in the world, forget about the wealthiest, we know that. They're the most well-informed traders. They drop crumbs, they give you clues. And so when we see a head of a central bank saying we're going to increase our holdings to 30%, instead of buying more treasuries, one that is aligned with the West, because we're very concerned. And if the power gets cut off to the global financial system, well, this is why we own gold.
As we step back and consider the broader picture, several critical dynamics come into focus. First, silver's designation as a strategic mineral marks a turning point. It is no longer just a speculative play or an industrial necessity. It is now part of the national security conversation. This adds a layer of competition that could lock up supply for years to come. Second, the market structure itself is increasingly fragile. The mismatch between paper claims and physical availability has always been a concern, but today the gap has widened to unsustainable levels. With lease rates at 5 to 6%, far above historic norms, it's clear that physical silver is no longer easy to come by. This sets the stage for short squeezes and delivery crises that can ripple across the financial system. Third, monetary policy adds fuel to the fire. With the Federal Reserve signaling rate cuts into an environment already defined by asset inflation, Precious metals could be entering a period of unprecedented upside. History shows that gold in particular thrives in such conditions. But with silver already outperforming and showing signs of unique structural strength, its trajectory may well outpace gold in percentage terms. This is why analysts like Andy Schectman describe silver as a coiled spring. Every indicator suggests that the release of energy is not only possible, but imminent. Fourth, we cannot ignore the global context. From BRICS nations moving away from dollar dependence, to Poland's central bank announcing plans to raise gold reserves to 30% of total assets, the evidence is mounting that sovereign players are preparing for a monetary realignment. These decisions are not symbolic. They are strategic. They reflect a recognition that the world's financial system is stretched, fragile, and in need of hard collateral. Gold provides that collateral, but silver, with its dual role as both money and industrial necessity, may be the wild card that takes markets by surprise. Finally, for individual investors, the implications are profound. The public remains overexposed to equities and derivatives at a time when insiders are exiting at historic levels. Meanwhile, gold and silver continue to outperform, often quietly, without media coverage. The divergence between perception and reality is glaring. For those who recognize it early, this may be one of the most compelling opportunities of the decade. If you found this breakdown valuable, make sure you subscribe to the channel, leave a comment with your thoughts on silver and gold's future, and share this video with fellow investors who need to see the bigger picture. Thank you for watching, and stay tuned for more deep dive analysis into the forces shaping global markets.